So welcome everyone to today's live stream with Sygnum Co-Founder and Group CEO, Mathias Imbach. I'm Dom Castley, Sygnum CMO. Welcome and good morning, Mathias.
Good morning, pleasure.
So first off, a big thank you to everyone who's tuning in today and those who have sent questions already into us via email. So we're certainly in a very interesting place with the global capital markets right now. On the one hand, equities have had a very strong run in 2025, driven by big tech and AI. Bitcoin also reached its new all-time high at around 125K US. But on the other hand, there's been recent concerns of an AI bubble, some legislative delays due to the US shutdown, and some perhaps dialing back expectations around rate cuts. So certainly some risk-off moves and bouts of volatility. So while there's some cautious segment, but we can also zoom out and see the industry quietly building some infrastructure in the background. So we're going to be covering a bunch of these topics and answering questions today. Thank you very much for the questions you've sent in. Today's session will be around 20-25 minutes, and we'll get to as many questions as we possibly can. As always, nothing on today's live stream will constitute investment advice. So please send your comments and questions through now. So let's get started. Okay, you ready, Mathias?
Yes, sure, Dom.
Super. So let's start with the question that's on everyone's lips, Bitcoin. So the question here is, we've just seen Bitcoin drop below 90K for the first time in about 7 months, erasing almost all of this year's gains. From your perspective, what are the real drivers behind this latest leg down in risk assets, especially Bitcoin?
Sure, I'm happy to give you my perspective, which is one, of course, of many, but look, we are a bit in a maturing phase of this cycle, and then with everything that's going on, this typically tends to, in terms of narrative, from a narrative standpoint, to maybe overemphasize negative news in terms of price action and underestimate and underemphasize the impact of positive news, and that's kind of, we are a little bit in that phase now. Ultimately, Bitcoin obviously is a risk-on asset. It's an asset that is heavily driven by narratives, by emotions, and then obviously with the overlay of leverage, of options around it. And so now the last few weeks, there's been just a number of mini shocks in terms of news flows that have led to this drawdown. I mean, one is obviously the big one on the weekend of the 10th, 11th around the US-China trade announcement by President Trump, which has led to a huge cascade, lots of significant liquidation. I think up to 19 billion or so were liquidated. That was kind of the initial leg, and then since then, that increased fear of a potential AI bubble, even though it was a bit alleviated last night with the NVIDIA results that were actually very positive, which now then also led to a bit of a counter rally. So that's the second part. Then obviously, thirdly, big discussion around rate cuts. Where in the cycle are we, right? The Fed has the minutes from the last meeting are a bit ambiguous. So the likelihood of a rate cut in December has actually fallen to now, I believe, to around 30%. So that all these things together have led to this sell-off. Apart from the one on the 10th, 11th, which was a very sharp one, it actually has been quite gradual, and which I find quite interesting. Maybe last thing, obviously, this is also what comes with more institutional access and interwovenness with traditional financial institutions. We have also seen a large outflows in the last, I think, 2 days or so on the largest Bitcoin ETFs, and all of that together has led to this.
Yeah, I mean, just going on a little bit more about correlation, which you're speaking there, we're seeing crypto equities and gold and the dollar are falling all in tandem. So can you go a little bit more and double click on why do you think this is happening? Because traditionally crypto has been not strongly correlated with this. Is this a normal liquidity squeeze, or do you see something more?
Well, to some extent, I could only repeat what I've said before. I really think we're in this maturing cycle, and negative news is overly is just taking center stage in terms of how people react, and of the risk asset, of the riskiest asset, of the risk on assets, Bitcoin is very much on the far spectrum, right? We've also seen that over the last few days. If you look at Nasdaq versus Bitcoin, Nasdaq has been doing much better on a relative basis. Bitcoin is obviously still seen as a bit more out there on the risk curve, but overall there's just a lot of nervousness in the market. But I always say, in doubt, zoom out, right? When last time the kind of the end of the cycle was announced, that the classic 4-year narrative, Bitcoin 4-year narrative, what happened then was we had rising interest rates. We had stuff like Terra Luna and other collapses happening. That's kind of a very different environment from what we have today, where actually, if you really zoom out, many of the underlying factors actually would point to the environment being very conducive, right? So far, the inflation rates have not been as sticky or as high as or rebounding after the Trump trade situation as people would have expected. We still have some quantitative tightening, which is about to end in December, which actually is a positive impetus. Generally, we have the expectation that the closer we get to midterms, the higher will be the pressure by the US government to actually inject liquidity into the market. We have the rates are still high. They may not drop rates further in December, but certainly I don't know anyone who expects them to stay up there for all of next year, for example. So there's a lot of kind of actually impetus which should be conducive for risk on assets incoming over the next maybe 2 to 6 months. And so you can either take the view this is a bit of a shakeout, a lot of negative news, and obviously the 4-year cycle narrative, particularly with regards to Bitcoin, which in the psychology plays a major role. Or you can take the view and say, look, it's a bit of a bump, but if you zoom out, actually the upcoming 6 months, the environment should be very conducive for Bitcoin and risk on assets.
Yeah, I mean, can I ask you just a little bit about the cycle, because normally at this stage of the cycle we see peaking retail interest there. What's your view on the actual the continuation of the cycle? Do you expect it to change or not be there or continue? How would you see that?
Well, that's the big debate, right? Is it the 4-year cycle? Is it still the same, or is it different now that the institutions are here, that we have digital asset treasury companies, that we have all these ETFs out there, we have even pension funds, etc., being invested in the asset class, many banks integrating it into. So is what changes, or is it still there? I think nobody really knows, but what I know is that the psychology around the 4-year cycle will always be at play. It's just out there. It has always been like this. So there will be traders that will act on it, and then it can kind of lead to a little bit of self-fulfilling prophecy. So in that sense, we will never get fully rid of this 4-year cycle narrative. And in that sense, to some extent, that's also happening now. The question really is, to the points I've made before, whether if we look at liquidity, the actual liquidity in the markets, which usually is the key driver of Bitcoin in particular, then actually you would have to say it should not be the end of the cycle, because there's a lot of liquidity expected incoming, and hence I can only leave you with you have to, as a trader, as an investor, have to make up your mind what you believe in and what you believe in more, and then position accordingly.
Yeah. The next question we had is, have we fully entered a bear market in your opinion? I think you've just answered it, right? It's what you believe in.
Yeah. I very personally don't think so, but I also know from previous cycles and from previous drawdowns, whenever you think, okay, now it's enough, that really is painful, then usually it goes even further, and that is true both ways, right? It's true downwards, but then also upwards. I mean, I like the stats. For example, if you look last 5 year-ish, the Bitcoin over the 5-year cycle, you've had a massive return, which is a number of X's up. However, if you then over the same period take out the 5 days with the highest leg ups, your return on Bitcoin would only be 20%. And so that shows you how generally as a narrative you could say, if you have a long-term view and the belief in the asset class, then is always the following is the truth, is true, is namely that time in the market beats timing the market. And sometimes that requires removing yourself a bit from the screen and from the daily price action. But obviously you can only do this if you're not leveraged, or at least not over leveraged, because if your potential for being wiped out in a sharp decline is then obviously the end of the story.
Yeah, certainly good advice for hodlers there. Moving on to quite an interesting area about online prediction markets. Question is, how are online prediction markets influencing price discovery in major digital assets like Bitcoin, Ethereum, etc.? What are the big risks when integrating them directly into DeFi?
I mean, it's obviously been a huge increase in attention. There's also been big investments, for example, by ICE into prediction markets. So there seem to be more and more people believe that this is really going to take off, and it has, right? If you look at the activity over the last 12, 18 months, it's very significant. It's obviously from a psyche and from a psychology and from a coming from the crypto side, obviously this is liked because it's direct, it's decentralized, it's on chain, it's close to the action, and it's driven by the crowd and not the establishment. So in that sense, I'm not surprised that this is driven from the sector and also wanted. There are of course challenges if you have on-chain oracles integrated with all of this. These can be manipulated, and we've seen that in the past, right? So that bad actors can potentially manipulate and win outsized returns in very short periods of time. We saw that around the situation when there were rumors around Michael Saylor selling Bitcoin over the last few days, etc. So that's something to work out, and I expect also regulatory frameworks and regulators stepping in if the growth continues like this, and to set guardrails, because ultimately it's an exchange. There's money flows, and so we want to avoid accidents.
Yeah. So I've got 2 questions all grouped together here on stables. So what should investors care about with stable coins apart from them being fully backed? What's the other things they should be looking at?
Well, obviously whom they issued, there's a number of reasons, but not in order of priority, but that just come to mind. One is obviously who's the issuer. Is the issuer trustworthy? Is it one or a number of issuers? And what is the regulatory framework around it? So that is one that then establishes trust or less trust. What is the audit trail? How are they audited? How are reserves being managed? What are the counterparty risks that the entity, the issuer, takes for managing these reserves? Right. There's also depends on the regulatory frameworks, but also choices that the issuer makes. It's things like what are the chains that the stablecoin operates in? Is it a public permissionless chain or chains, or is it a private permission setup? Is it a walled garden? I would hope that the public permissionless chain side will win, which is currently happening. More than 50% of all USD stablecoin, and which is 99+% of stablecoins in circulation, are, for example, built on Ethereum, which is exactly going in that direction. But then there's also questions around which are the players through which, or the ecosystem around which you can change into other asset classes, be it fiat but also other on-chain assets. So kind of how is the ecosystem established around the stablecoin? With which players is it integrated? So that is then another thing you need to obviously keep in mind. And then you ultimately, there's also, is there a kill switch? Can it be switched off? Can it be confiscated? Is it linked to behaviors? There's obviously utopian things like certain stable coins that could be limiting you purchasing alcohol and other things that some other centralized entity may not like. So these are some of the things to watch when it comes to which stablecoins to interact with. But it goes without saying, since the Clarity Act, the Genius Act, apologies, is in place, and the US is really pushing at this front, we see a huge wave of entities starting to collaborate and or to issue stablecoins. And I believe the future will be that the payments will be made on chain, on the fly, very quickly. Whenever something, when there's nothing to be paid, immediately switched into yielding, be it money market funds or crypto or whatever. And so in that sense, I'm very excited about this development.
Yeah, sure. You spoke a bit about counterparties and centralized. What about, for example, if it was managed by a decentralized stablecoin, for example, by a DAO? How would that change your thinking?
Well, I would say so far, whenever stablecoins that were, let's just say so far, there's not many examples where over a long period of time this has gone well. So it's ultimately at the user's discretion to judge whether the user is happy with the governance, the transparency of the whoever issues the stablecoin. Personally, I like the idea of having a DAO and a decentralized infrastructure that issues something like that, and that it works. However, I believe in the grand schemes of things and at scale, the broad population may now and also in the future, probably be more inclined to trust entities that ultimately have people behind that they can grasp, people and or governments and or entities that they can grasp and make accountable for it and pin them down, so to say, if something goes wrong.
Sure. I mean, sticking with stablecoins for a moment, and I guess a big question just come in for how do you see the role of stablecoins and the DeFi yield in the context of a traditional, a TradFi portfolio then?
Well, one thing I can say is I'm positively surprised how fast the convergence of traditional finance with more decentralized financial infrastructure is now accelerating. A year ago, it was almost impossible to interact, particularly as a regulated financial institution, with more DeFi infrastructure. I think, again, the 180 in the US has changed that. The Clarity Act, which is going, which is will be voted on in December, will provide more clarity, including things like the right for self-custody, which is obviously a foundational pillar for DeFi to work, has led to regulators being much more open to exploring how these two systems can interact and interact. So to me, it's just. It will over time be very natural for these flows to go between hosted wallets, custodians, and then more DeFi wallets. But the custodians will always be the counterparties through which you then have access again ultimately to fiat, also from an AML, an anti-terrorism financing protection standpoint. So I think there's a long way to go for these systems to truly integrate, but we're seeing great strides being made. One example, it's not stablecoin related, but the recent news that One Egg and securitized money market fund is now on Aave's horizon, as an example, is a case in point that these two worlds are increasingly converging.
So we're sticking to kind of infrastructure style topics here. Here's an interesting one, similar. Many tier one banks are talking about going on chain. What do you think is the end game? Is this moving back office to be more efficient or getting rid of legacy infrastructure, or is it really the end game is tokenized deposits and securities?
Well, it's a lot to do with it starts with the very basics. It's like, okay, now there's the okay by the biggest capital market, the US, that this infrastructure is accepted, that blockchain will play a role in the future of finance and financial market infrastructures. And now, of course, banks are getting their hands dirty finally at scale by enabling first and foremost the infrastructure. So whatever you do, be it crypto, stable coins, tokenized money market funds, or other tokenized securities, you need the infrastructure to custodize and to trade these on-chain assets. And an increasing number of banks, they believe that in the future, 5-10 years, most of the new issuances of securities will be on-chain. So as a result, you need to have the infrastructure, you need to manage the cash leg, which is the stablecoin situation, and you need to get involved with the the tokenized asset. So we're in this phase of enabling this infrastructure. So that's why banks are investing in it and sometimes also a bit scrambling. And then the other thing is that we should not forget is banks obviously have self-interests. They want to make sure that their deposits business is not gone. So they were obviously happy that in the Genius Act, stablecoin issuers cannot give yield, for example. So that protects bank deposits. As a result, we are also seeing all these initiatives around tokenized deposits or deposit tokens, which is basically an on-chain form of bank deposits where banks are working together. We are also doing this in Switzerland with UBS and Post Finance, for example. So this is a very interesting phase where we're seeing the start of a true inflection point, how financial market infrastructure is moving on-chain, and the key custodians of our financial market infrastructure and intermediaries, the banks, are getting ready for this and now heavily invest in it.
So just a question's just come in. There's a bunch on AI, unsurprisingly here, but here's one which I think captures a bunch of it. It's a long question, so bear with me. AI infrastructure spending is running into the hundreds of billions, often funded by corporate debt. Now we're seeing investors question whether all that expenditure can be monetized. Alphabet's CEO has warned that no company is immune if the AI bubble bursts. Peter Thiel and SoftBank just offloaded the NVIDIA stock, which is interesting given the results. And is this all part and parcel of a broader risk aversion, or we're watching the AI-driven bubble inflate? And what's its connection? Does that spill over to crypto?
Well, to your last point, of course, if there were to be a huge burst of AI bubble, of course, it would have impact on risk assets, including Sygnum, because it would lead to a market meltdown, which very likely would also pull down crypto further with it. That goes without saying. Now, are we in a bubble? I mean, look, looking at the past, whenever you have new technologies, there's excitement, overexcitement. At some point, the bubble develops and then ultimately bursts. So I would expect that we will see something like this also happen with AI. That doesn't mean that it happens right now. Who knows? It's very hard to predict. Second, I mean, when we look at the data last night, the results that NVIDIA has shown, and has shown how strong that actually it may be seen as a bubble, but it's also incredible what then the ultimate result is in terms of financials that these companies drive. So in that sense, we don't know where we are, but will there be at some point a bubble? I would say yes. That doesn't mean, however, that the technology that leads to a bubble and the bubble bursting is not fundamental and foundational for future, particularly convergence of different technologies. And to bring back the two or combine the two, I'm very convinced that we will see over the next 12 to 24 months a significant convergence of the storyline, also how AI will have to work with crypto and on-chain for it to truly scale. I cannot imagine agents, if we talk about on-chain purchases, etc., that or agentic payments, that these will be happening on the Swift network. So there will be the convergence of AI and agentic models with stablecoin and an on-chain environment, and I'm very excited about this. We're seeing L1s like Ethereum. They have built working groups and engineering teams that now work on making the layer one, the blockchain, ready for such use cases. And I can also tell you that obviously we are also thinking about what role crypto banks such as Sygnum can play in this in the future.
So I'll do one more question now, and then I think it'd be good to finish off with the question we've got regarding your outlook, of course. It's back to ETFs. First wave of ETFs was mostly just Bitcoin price exposure. Now we're seeing Solana staking included. What do you make of all these products landing at once? And what does the shift tell you about the appetite for non-Bitcoin assets? And which concrete use cases are institutions actually backing?
So the fact that we now have more ETFs, so first point is the fact that we have more ETFs that have a broader range of assets is just, there's more clarity from the SEC what it requires. The listing requirements are more clear, and obviously it signals openness. So in that sense, it's just an institutionalization and a reaching maturity around that. So it's not an alien thing anymore. And if you want to create an ETF around a layer one or so, you just do it, and then the market shows will play out, right? Actually, it was interesting that over the last few days, I checked last time, about 3 days ago, there were actually inflows into particularly Ethereum and Solana ETFs versus Bitcoin outflows. On a small level, but it was at least for a few days the case. What are institutions backing, or why are people investing? I mean, first and foremost, it's convenience, right? It's easier. They've already have everything. They have their bank accounts are fully integrated with all these ETFs, and so it's just an easy way if you want to invest in crypto, whatever your story is and what you believe in. It's just a very easy way, and that has been driving the growth over the last few months as well. And then in terms of the actual use cases, again, that depends on what you believe in. For Bitcoin, is it digital gold? Is it an alternative future currency system? For Ethereum, it's the Internet of Values machine. It's the internet computer in some sense, right, where you can create everything you do in this on-chain world, including issuing stable coins and transferring stable coins, happens on these layer ones. So which are the winners? And so people back which entities or layer ones, not entities, they believe in. So it's just classic making it easier to invest in the blockchain world. And for me, it's not more, not less than that.
Yeah. Just to finish up now, I think this is a good one to end with here. It's a simple question, but maybe not a simple answer. Is outlook. Looking to 2026, what are the biggest risks and potential tailwinds for crypto?
So, I mean, risks are if there's risks is if the 4-year cycle narrative psychologically were to really stick. Of course, then next year would not be the best year in crypto from a price action standpoint. Of course, further geopolitical or trade related shocks would not be positive. If suddenly inflation picks up massively, the Fed has to stop and then hike again on their interest rates. Kind of all these macro related risk on, risk off drivers. This is kind of a tail risk, which I believe is kind of a risk which can happen if things go sour. But on the other hand, on the positive side, if you zoom out a little bit and you look where in the cycle we are, there's actually many things pointing towards more liquidity, lower interest rates, less sticky inflation overall, more resolutions on the trade wars. Every week or so we're hearing about new deals that are being made. So in that sense, there's a very positive outlook as well. And irrespective of what happens, I'm seeing so much innovation. I'm seeing so many great teams building the future financial market infrastructure. So if it were to be a bit of a muted price action year, it is, as in the past, a great opportunity to continue building. And we've passed the inflection point, so nobody is going to stop that general move towards putting things on chain. So I'm calm and excited about what's to come.
Yeah. So fantastic glass half full ending for that. But I think that's all we've got time for today. Thank you everyone for emailing all your questions into us. Especially thank you, Mathias, for your time today and sharing your views on the market and a lot of interesting topics. So most of all, thank you everyone for sending questions in and tuning in today. If you'd like to learn more about Sygnum, please visit our website and feel free to follow us on social media for all of our latest news and research. So that's goodbye from here in Zurich, and everybody have a great day.
Bye-bye. Thank you.